Hey, what's up, dividend growth investors? Mike Leroux here. Welcome to this quarterly earnings review for Canadian banks. Every quarter, I go through the big six, and I also added EQBank and GoEasy to this review. So you're going to get the entire picture of what really is going on with those Canadian banks. Let's get started with the year-to-date results. Keep in mind, we're just like 2 months in, so it doesn't mean that much right now. So don't get too excited to see TD Bank and BMO like leading the way up like 12% and then 8% for BMO. It's great. They had a rough year in 2024, so it's kind of like normal that we see them going back up. What is mostly surprising here, though, is who's the biggest losers in the beginning of the year? Yeah, that's National Bank. Kind of crazy. We're going to get there in a moment, but the market did not like their results. So we'll have to do a deeper dive on this one and see what's the story here. So I just want to highlight one more thing here is between National Bank at -8 and TD Bank at +12. It is a wide range of returns. So when you're thinking, oh, I'm investing in Canadian banks, they're all the same. Well, they're completely different these days. And it's really important to understand what's the main characteristics that are different from one bank to another, because you don't need to own them all, and you can actually make better choices by looking at financial metrics. So let's get started with what really happened this quarter. When we look at the dividend payments, nothing was changed this quarter, which is normal. So nobody expected any dividend increases. All the banks that are increasing their dividend twice a year, they did that in December. So there was no point of looking for a dividend increase at this point. So don't be crazy here. Adjusted earnings for Q1 2025. Big winners here. Royal Bank at +27, CIBC at +22%, BMO at +19. And then all the way back there, we have like TD still struggling a lot with their restructuring strategy in the US, anti-money laundering, and so on. So earnings per share only up 1%. ScotiaBank still struggling as well, up 4%. So not much to there. And then National Bank didn't show like a bad quarter at +10. So we'll have to see like what really happened. So the market did not like their returns. In terms of yield, we have a similar situation with the highest yielders are still Scotiabank, CIBC, and TD. And then we have like two companies like National Bank and Royal Bank offering less than 4%. In terms of payout ratio, things have changed a little bit. Of course, when you have like earnings that goes up by 20%, that will also help to show a better payout ratio for the quarter. So it's not for the past 12 months, but just for the quarter. Everything goes from like 40% all the way up to 60% at Scotiabank. Didn't increase their dividend last year. The bank also that is offering the lowest earnings growth this quarter. I mean, kind of like a redundant story here, so just keep that in mind when you're about to make any investment decisions. So what was the story here? So let's get started with BMO. The revenue went up, but the provision for credit losses are still out of control. So I was kind of like surprised to see the market liking this quarter. Personal and commercial in Canada down 3%, US retail up 2%. So nothing happened over there. So higher revenue on higher interest rate, but hurt by higher provision for credit losses. What saved the day, though, is wealth management and capital markets. And you'll see that as I go through all the other earnings. It was really the two departments that did a lot better than anything else. And that kind of like saved most banks from a mild to bad quarter. So BMO is known for being very strong in wealth management and also on capital market. Keep in mind that for wealth management, the thing is, since we had a pretty good year, and keep in mind the earnings for this quarter starts on November 1st for banks. So you have November, December, and then January, like 3 months that were pretty good actually on the stock market. So higher fees on assets under management. Assets under management have been increased over the past 12 months because of this great bull market. So it's just normal that they're making more money. And then capital markets, well, that usually fluctuates a lot, but in this case was also a pretty solid quarter for BMO. Now for National Bank. Let's get started with the bad news. And this is really what hurt the stock price on earnings day. Personal and commercial banking mostly is like Canada, and mostly is Quebec, about 50% of it, down 14%. Their provision for credit losses like more than doubled this quarter, and that hurt big time the earnings and of course the perspective of a very bad year coming up, especially on the banking side. So that brought National Bank down, and the investors were just like getting off that honeymoon that lasted for so long. So of course that was a really bad signal, actually the worst performer in personal and commercial across the big six. They fortunately were able to count on the wealth management, capital markets for the same reasons as BMO, and also the US specialty Credigy, and then international market at plus 22%. So everything else was doing fine. So this is why the earnings went up by 10%, but the concerns around classic banking activities and a very strong increase in provision for credit losses is not a good signal to what's coming up, including tariffs, including like still the lagging impact of higher interest rates for the past 3 years, even though now it's slowing down a little bit. So all of this negative narrative being translated into higher PCLs. Not going to be an incredible year for National Bank, probably. Interesting fact as well is they completed the acquisition of Canadian Western Bank. That deal was announced last year and was expected to close at the end of 2025. So they did it a lot faster, which is good news. So now it's going to open the door to expanding their business in Western Canada, cross-selling opportunities, and also tap into that 37 billion commercial loans book to offer wealth management services. Moving on to TD. Well, TD had a pretty busy quarter as well. It's rare that we have like so many stories right here. Personal and commercial in Canada up 3%. Not much to say there. Pretty much the same story as all the others. The revenues are growing high single digit to double digit for all banks due to higher interest rates, but PCLs are bringing everybody down to hurt. On the US side, so it was down 79% excluding Charles Schwab's. Why do I exclude it? Well, they just completed the sale. They will report a 8 billion something of capital gain for Q2 in 2025. So they divested their stake into Charles Schwab's. They're also looking at restructuring the whole thing because those are like extraordinary charges. It brought down the earnings really low. TD has to invest massively into their anti-money laundering practices. Their intent to sell more assets in the US to recycle a little bit, so make some profit and then use those proceeds to invest into new assets. So they're in the middle of that. So of course it was a little bit hard, but overall the market kind of liked what they saw. Wealth management was up 23%, capital market up 14%. So overall they kind of like saved the day with that restructuring, and the market kind of liked the sell of Charles Schwab, generating a lot of capital gain and a lot of like free cash flow coming in. For Royal Bank, well, they made a major acquisition of HSBC last year. So now you have bigger numbers here. So 24% up for personal, 20% up for commercial, wealth management up 48%. 24% for capital market, 24% for insurance. Was definitely a very solid quarter for Royal Bank. Everything is up double digit. Not much to say about that besides this. So, and even without HSBC acquisition, the numbers were up high single digit as opposed to what we have seen with BMO, National Bank, and TD Bank so far. So definitely one of the biggest winners in this quarter, in my opinion, by the numbers. CIBC, personal and commercial, up 7%. The US went from a loss of 8 million all the way up to a profit of net income of like 256 million. They used the classic playbook for all bankers of cranking up the PCLs as high as possible and then recovering some of this the following year. So while other banks are increasing their PCLs, this one is actually doing better in the US. That generated some profit this year. Last year was a tough one. This year is a better one. So it's kind of like even out in terms of the results. Wealth up 13%, capital market up 30%. Similar story there as other banks. Moving on to the last one and definitely the least, ScotiaBank, personal and commercial down 6%. International down 9%. The bank mentioned that they sold their banking activities in Colombia, in Costa Rica, and Panama. So they're trying to recenter their focus in Latin America to make better choices going forward, but they had to record an extra charge, an impairment charge on the sale of those assets. So as opposed to TD making a capital gain on Charles Schwab's, well, Scotiabank is actually having an impairment of like roughly $1 billion on selling those banking activities. Again, got saved by wealth management capital market. So thank God for a bull market. The banks were saved by this. Moving on to the two smaller competitors here, narrowly focused on the Canadian market, EQBank and GoEasy. So what up with EQBank? Well, EQBank revenue up and earnings up 8% both. Pretty solid, fueled by a double-digit customer growth, so up 26% year over year. So they're gathering a lot of new clients. They're making a lot of money by like opening those accounts, getting more deposits, increasing their loans as well. Everything seems to be rolling pretty smoothly for EQBank. The PCL ratio was quite low, actually, 28 bips. So only 0.28% of their loan portfolio is subject to provision for credit losses. So that's a pretty low number as compared right now, like some banks are going up to like 50 bips or 60 bips. So I'm always a bit concerned about this, but so far EQBank, and same thing for GoEasy, they've been able to maintain a very high quality of loan portfolio. Their underwriting process is amazing. And that came with another increase of the dividend, another 4% jump. Dividend increase every single quarter since 22, kind of like a new tradition. EQBank is trying to seduce some investors with this, I guess, and also reinstating the fact that they're fully confident in their business model and going forward. The stock price dropped a little bit over the past few months, mostly probably due to the economic uncertainties around tariffs, around what's going to happen with those interest rates and so on. But so far, so good. EQBank continues its growth story. Similar story for GoEasy. Kind of crazy because revenue went up by 20%, earnings per share by 11%, and they came on strong with a dividend increase of 25%. Kind of crazy. Just to put everything under perspective though, EQBank, year over year, the dividend increase was 21%, just that they increase every quarter, while GoEasy is not increasing every quarter, but still 25%, pretty solid increase. The loan portfolio grew by 26%. That explains the growth up to now 4.6 billion of loans. That's a lot of money. So on one side, it's interesting because they're making a lot of money. Their underwriting process for the loans are amazing. But at the same time, I cannot help myself thinking Canadian needs a lot of loans right now and like how it's going to end. So just be careful with those type of like lenders. So far, they've been doing great, but I'm always concerned about what's going to happen when we enter into a recession. To end up on that note, the charge-off, so like what they're losing on their portfolio, it was at 8.4%. That seems high, but actually it's pretty good. It's on their target. Their target is between 8 to 10% roughly. So right on target for that. Not a problem. They're highly profitable as long as they have their charge-off under 10%. So a pretty solid quarter for GoEasy as well. Now going back for Canadian banks, the PE ratio, the valuation, is there any deal right now? So when you look at the current PE ratio, it's kind of like all over the place. We have like National Bank and CIBC at like 11 times the earnings, but it goes all the way up to 18 times the earnings with TD. But of course, with TD and BMO, we see that like those graphs are going up and down everywhere because there were a lot of adjustment over the past few years. So it's probably a better idea to look at the forward PE ratio. So what we expect in the next 12 months. And that is a lot more stable. We see that the best deal seems to be Nova Scotia. So Scotiabank, like to be honest, it will always be the lowest one just because it has like less growth perspective, similar to CIBC. Those two ones, they're trading at a lower forward PE ratio just because we expect less growth. So it's not necessarily a deal here. I would say everything that is between 10 and 12 is probably a good time to enter. And that lead me to say, while National Bank actually had a good quarter in terms of earnings per share, of course, it was just driven by wealth management and capital markets, not by the classic banking activities. So that's why the stock price dropped. But the PE ratio right now, the forward PE ratio at 11 times the earnings, pretty decent, actually. You'll have to pay more for quality, especially for Royal Bank at 13 times the earnings. Still one of my favorite banks right now due to its well-diversified portfolio of activities and its size. I'm still a big fan of National Bank. It's not because they had a bad quarter that I'm going to drop them into the trash. Actually, I'm going to keep my shares. I'm super happy shareholders of both Royal Bank and National Bank, but I'm actually curious to see what you think about National Bank at this point. Like, are you finally tempted to get in? Because I mean, if you've been waiting for a while, it's probably the right time for you to consider National Bank a little bit more. Of course, that's not a buy recommendation. You have to do your due diligence, and if you already have 4 banks in your portfolio, there's no point of adding another one. So what have we learned this quarter? Well, we have learned that banking activities are on the spotlight. The provision for credit losses keeps on increasing for most of all banks. Not a good thing. We kind of like see that there's a bad narrative growing around the economy. A lot of uncertainties, of course, and that will likely going to continue moving forward. The second thing is wealth management and capital markets saved this quarter for all banks. They were generating double-digit growth for both segments, mostly driven by this crazy bull market. So at one point, it's going to end. And if this ends and we have higher PCLs on the other side, it's going to be very hard for most banks to generate interesting returns. So we'll see how it goes, but just put on the brake on the enthusiasm for now. I mean, it's great. Some banks are doing great. Good for you, but just don't go crazy there. It might be a tough year in 25 as we look at other type of businesses. Their earnings report are not that shiny, so just keep that in mind. The biggest losers of this quarter, National Bank and Scotiabank. Scotiabank, I mean, it's like the usual loser, so that's kind of like normal. They keep on struggling. They need to restructure the whole activity, so we'll see how it goes, but I'm not surprised that they lag behind other peers. For National Bank, that's the first. It's been a while. Definitely a good slap on the ends and just like a wake-up call. It's like, dudes, like you're growing, it's great, but just keep in mind that your personal and commercial banking activities are super important. And if your underwriting process goes sideways like this, it's going to look like BMO last year. Just be careful about that. So anyways, something to look for in the following quarters. At this point, definitely not worried at all. On the winner side, I would say BMO, that is doing a lot better than last year. Still concerned about the PCLs though. And then Royal Bank reported very strong numbers across the board. The acquisition of HSBC is also boosting all the numbers, which is good. But I'm definitely expecting another great year for Royal Bank. A lot of like dividend increases there as well. And I expect this one to be a good performer throughout 2025. All right, guys, that's enough for today for this review. Do not forget to like this video and subscribe to the channel to not miss my next video next Thursday. I'm going to see you in the comment. I want to know which banks do you have right now and which one do you have your eyes on? Are you thinking about buying National Bank finally? I don't know. I'm just curious. Let me know in the comments. I'll talk to you next week. And until then, don't forget to stay invested.